Here's something interesting. 13F filings revealed that while retail investors were panic selling, the biggest names on Wall Street were loading up. Talking about Warren Buffett, Ken Griffin, and Bill Ackman. All of them bought aggressively while others ran away. Right now, a ton of channels are telling you to copy their trades because of their past track record. That's not what I'm going to do today. Because for as smart and wealthy as these guys are, some of their favorite picks just don't stack up. Gladly, some of them do, so it's worth a much more in-depth analysis to make sense of it all. Our best friend to analyze these stocks is our proprietary quant model, the Zen Ratings, which looks at stocks across 115 different fundamental factors. Then it assigns intuitive letter grades of A through F. Just like in school, we want more A's and B's and less D's and F's so we don't get punished. I ran their picks through that system. I'm here to tell you that blindly following their trades isn't an approach that the data supports. But just pointing out the weaknesses of other people's stock picks is of no value unless we share more attractive alternatives. So stick around to the end to appreciate all 7 stocks we recommend instead. By the way, I'm Steve Reitmeister, and I spent over a decade as editor-in-chief of Zacks.com, where my commentary was read by millions of investors. And now I'm a partner at WallStreetZen.com, where we develop the Zen Ratings to help investors beat the market. So here's what I'm going to do. I'm going to show you 7 stocks in the very same industries that these billionaires have been investing in, but ones that have stronger fundamentals and brighter futures than their stock picks. Quickly before we begin, hit that like button. It trains the algorithms to show you more research like this and fewer of the videos that waste your time in the future. Now, let's take it from the top. Here are some of the biggest trades that showed up in their recent 13F filings. Now, Warren Buffett opened a new position in the New York Times, then increased his stakes in Chevron, Chubb, and Domino's. All of them earn very uninspiring C grades from our system, which implies average future returns at best. As for Bill Ackman, he built a major new position in Meta and then increased his Amazon holdings significantly. Again, modest C grades, mostly based upon the lofty valuations the Mag 7 have achieved over the years. Ken Griffin of Citadel also added billions to Meta and Amazon. Here again, like we noted, C grades above. And then there is Nvidia. Griffin Citadel added 11.7 million shares, nearly doubling its position in a single quarter. Finally, a stock that our system smiles upon, pointing to much greater likelihood of outperformance ahead. And we will dive more into Nvidia in a moment. Here is the most important thing from these legendary investors. Their choices of themes is right on the money. AI, insurance, energy, consumer staples, media. These are generally solid industries, but in almost every case, the data says they bought into the most famous names in the sector rather than the fundamentally strongest or the ones with the most upside potential. This is no doubt because of the size of the trades where they are betting hundreds of millions, if not billions, on each position. Now, for retail investors like ourselves, we don't need to worry about moving the markets with a single trade. That distinction is exactly where we have an edge can be found to help buy the most attractive stocks like the 7 that we'll cover today. First up is the most obvious of the picks today. Of course, I'm talking about Nvidia with a symbol of, you know what the heck the symbol is. All right, they are the dominant force in AI chips, where their GPUs power virtually every major AI training and inference workload on the planet. Nvidia needs no further introduction. The financials component grade ranks in the top 1% of all 4,600 stocks we track. Now, with a return on equity above 100%, profit margins approaching 56%, revenue hit $215 billion the past year, up over 65% year over year, and earnings are a jaw-dropping $120 billion. 32 Wall Street analysts cover the stock, where the overwhelming majority carry strong buy ratings. Here is where the picture gets a bit more complicated. 2 component grades tell a slightly different story. Safety lands in the bottom 16% of all stocks in our universe, no doubt about the extra volatility in shares. And momentum also sits in the middle of the pack, which is notable for a stock carrying the level of institutional conviction that Nvidia has. Now, despite the bullish fundamentals, the price action has been a bit choppy. Pulling back to the big picture, it scores a solid B grade in the top 20% of all stocks. Note that we prefer to discuss A-rated stocks in the top 5%, but given their track record of success, the B grade is still a meaningful result that deserves our attention. But if the most famous stock in the most talked about sector of the past 2 years only earns a B, what does an A look like in the same space? That question is where this video gets interesting. There's a pick on our list today in the same sector, and it has an A rating right now. So keep watching, and we'll share that with you. Now let's move on to the bull case for Deluxe Corporation with a symbol of DLX. Most investors hear Deluxe and think of check printing, which indeed is their legacy business, and the stock is priced like a business in terminal decline. That false assumption is exactly where the mispricing of shares lives. Deluxe's return on capital is 10.85% against an industry average of 0.9%. Over 10 times the rate of its peer group, while the market continues to look the other way. The transformation has been happening quietly for years. Deluxe has shifted from check printing into marketing technology, data-driven services, and business payment solutions for small and medium-sized businesses. This has resulted in 52% earnings growth the past year, and Wall Street analysts are predicting even more impressive 120% growth in the year ahead, and yet the shares trade for a forward PE of less than 7. Heck, even the average stock trades for closer to 20 PE these days, let alone one that has this much growth in its forecast. Here's the cherry on top. It also pays a 4.42% forward dividend yield, backed by 10 years of stable, uninterrupted payouts. The Zen Ratings gives Deluxe an A grade overall, which implies strong buy. On top of that, we have value in the top 9% of all stocks we track, growth sits in the top 15%, and safety comes in the top 18%. The risk in these shares is also visible in the data. Revenue has been essentially flat, which makes some investors question the longevity of current earnings growth. The catalyst that changes the narrative will likely be a sustained quarter of top-line growth, and the data suggests that inflection is closer than the current price implies. This is a patient money setup for value-oriented investors. But once the market wakes up to the growth story, it truly will be off to the races for Deluxe shares. Before we jump in the next pick, go ahead and hit subscribe and turn on the notification bell. If you want more research like this every week, you definitely don't want to miss the next video I come out with. Our third stock today is Nature's Sunshine Products with a symbol of NATR. Let's start with the best part of the story, that being the sentiment component score in the top 0.1% of all 4,600 stocks we track. So not top 10%, not top 1%, top 0.1%. That reading means the smart money already appreciate what is special about this company. Nature's Sunshine Products manufactures and sells nutritional supplements and personal care products across North America, Europe, Asia, and Latin America. They have gross margins above 72%. Minimal debt, and earnings jumped over 163% last year as operational improvements flowed through impressively to the bottom line. The same consumer staples category Buffett targeted with Domino's, yet with a much more compelling growth and value story. In fact, their value grade is in the top 10% of all stocks, and their financial strength is not far behind the top 14%. The main risk explains why the current discount to fair value exists. Given that their market cap sits under $500 million, it means thinner liquidity than most investors are used to, which keeps many on the sidelines. Only 2 Wall Street analysts cover this stock. Both give it a strong buy rating, with close to 40% upside to their fair value target in the year ahead. But given their earnings beat history, I expect fair value to continue to climb as they bang out more beats in the future. Thin Wall Street coverage is actually a positive because each new buy rating is a bullish catalyst. So good time to buy now before others discover this stock. We are just a few picks in and a pattern is emerging. Deluxe and Nature's Sunshine are both A-rated and both deeply overlooked. And yet they are in the same exact sectors the billionaires targeted through with their more famous stock names. That is what screening for the best fundamentals helps unearth. Not just name brand recognition or companies big enough for billionaires to load up on, it points to the best stocks overall. All right, that brings us to Mercury General with a symbol of MCY. 10 years ago, Mercury General was a regional California insurer most investors had never heard of. Since then, has grown earnings by 623%. Not in a single year, not through an acquisition spree, 623% organic growth over a full decade, including a devastating 2023 that would have broken a far less disciplined and financially strong underwriter. Revenue hit $6 billion last year, which points to a whopping 86% increase over the past 3 years. On top of that, the company carries a very welcome low beta of 0.58. Now, in a volatile market like we have now, it's nice to have a low beta stock like Mercury that has barely blinked while the rest of the market has been jumping all around. Growth ranks in the top 13% of the Zen Ratings database, which bodes well for results in the future earnings reports. Plus, our AI outperformance predictor comes in the top 6%, which means these should be very timely shares. Risk with property and casualty insurance is kind of baked into the cake, especially one focus on California where they have major earthquakes, concentrated storm cycles, and too often wildfires. These are not theoretical tail risks. They are business realities that can move earnings materially in a single quarter. So please consider this when you consider the sizing of any position MCY. Now, Buffett has spent his entire career in insurance because great underwriting discipline compounds powerfully over time. On that front, Mercury General and the world's most famous insurance investor appeared to share the same philosophy. The data just found it in a different ticker. Before we get to the last pick in the video today, a little quick reminder. Every Monday, I share my stock of the week with investors. This blends the outperformance found in the Zen Ratings quant model, along with my greater than 40 years of investing experience. So get my future stocks of the week for free by clicking the link in the description or scanning this QR code. Our fifth enticing pick out of 7 today is Ooma Incorporated with a symbol of OOMA. The Billionaires ignored telecom entirely this quarter. Not a single major 13F filing we reviewed included a meaningful new telecom position. Meanwhile, the number 1 rated telecom company in our database has been building exactly the kind of recurring revenue business institutional investors claim to love. In fact, over 90% of Ooma's revenue is recurring subscription revenue. That's because they operate as a cloud-based communications platform, with the fastest growing segment shifting towards enterprise and mid-market clients where contracts are larger and churn is much lower. This has helped the company grow revenue for 6 consecutive years. Ooma is also a leading provider in POTS replacement, the mandated transition away from traditional copper landline systems that still has years of runway ahead. That creates a structural demand floor beneath this growth story. The earnings forecast is where data gets most interesting. Over 160% earnings growth projected for the next year, which blows away the industry average, which is under 9. Now, growth, sentiment, financials, and our proprietary AI outperformance predictor all come in the top tier of stocks, which is an attractive, well-rounded fundamental profile. Granted, this is a smaller company, still in the early stages of sustained profitability, and so the bullish thesis requires patience. But a stock earning top-tier grades across 4 of the component categories, while trading at just over 1 times revenue, is exactly the kind of exciting setup this research is built to surface before the broader market catches on. We have to move on to more well-known stocks in Micron Technology, truly a highlight reel stock when it comes to our Zen Ratings analysis. Growth in the top 1%, value in the top 2%, financials in the top 2% as well. Those 3 outstanding grades explains why Micron is the number 1 ranked semiconductor in our entire database. Not Nvidia, but Micron. Remember that Citadel was loading up on Nvidia this quarter while the top-rated stock in the same sector sat largely overlooked. Citadel added 11.7 million Nvidia shares. They added none of Micron. That gap between where the institutional money went and where the data supports is exactly why this pick is so appealing, just not getting the love it deserves. And here's specifically why Micron deserves that top ranking. Micron makes the high bandwidth memory that AI chips cannot function without. Every next generation AI accelerator needs Micron's memory to operate. The AI infrastructure build-out runs through Nvidia's chips, and those chips run through Micron's memory. In fiscal year 2025, Micron reported revenue of $37.4 billion, up nearly 50% year over year. Couple that with stellar profit margins of 41.5% is why earnings grew dramatically and expected to rise 7x this year. Yes, a full 7-fold increase. Not surprisingly, Wall Street analysts love this stock. This includes 25 strong buy ratings from the likes of JP Morgan and Goldman Sachs, with over 40% upside to their average fair value target in the next 12 months. But when you appreciate the ultra-low valuation, then you understand why the max analyst forecast of 91% upside is much more likely to be accurate. That is a rare level of conviction from top-tier institution on a stock the 13F crowd largely passed over. The only blemish to note is the safety component rating, which sits in the bottom 16%. And that makes sense when you consider that memory chip business is quite cyclical. Yet right now, the cycle could not be stronger, leading to massive spending to increase long-term capacity. Our 7th and final stock today is LiveRamp with a symbol of RAMP. Let me start with the risk before we appreciate the broader bullish case for RAMP. Their customer base is highly concentrated, where a meaningful portion of revenue comes from just a relatively small number of large enterprise clients. If any major client relationship changes, the impact would show up quickly with share prices stumbling. Now, let's appreciate the excitement found in the fundamental data. LiveRamp is the number 1 rated software infrastructure company in our entire database out of 121 attractive companies. That's a very impressive feat. Here's the rest of the Zen Ratings honor roll. Top 13% safety. That's the strongest of any stock we're talking about today. Top 7% growth. top 6% value, and top 4% for the AI factor, which is focused on finding the most timely stocks. LiveRamp operates the leading data collaboration platform, the infrastructure layer that lets companies securely share and activate their data for AI and marketing applications. In a world where AI models need clean, permissioned data to function, this company is essentially the plumbing. This explains their gross margins above 70% and why earnings are forecast to grow over 46% in the year ahead. Bill Ackman put a major portion of his portfolio in Meta and Amazon this quarter, and both scored a yawn-worthy C grade. Whereas Ramp is a top-ranked stock in that same software infrastructure category and yet appears in none of these major 13F filings. Their loss, our gain, and that's a good reason to ramp up our holdings of these attractive shares. Here's the full picture side by side. The billionaires only narrowed in on one strong stock in B-rated Nvidia. The rest were lowly C's. Even their mothers would not put a gold star on the fridge for those poor grades. Remember, there's no argument about the industries and the themes behind those investments: energy, insurance, consumer staples, media, and AI infrastructure. The biggest investments in the world correctly identified where opportunity exists in the market. Our proven data just found fundamentally stronger stocks within those same areas. But identifying the right theme and identifying the right stock within that theme are two very different skills. The 115-factor review in our data gives you a consistent advantage. One major theme worth exploring further is where AI is headed next. Top analyst Dan Ives of Wedbush Securities has been one of the most accurate voices on tech for years. We broke down his latest AI stock predictions and what that means for your portfolio. That video is right here. Please enjoy.